Hello, thank you for viewing our second meeting on apartment investing terms you need to know. In this video, we're going to cover terms such as letter of intent, loss to lease, phase one site inspection, and much more. Enjoy the video. First term that we're going to review tonight is letter of intent. A letter of intent for multifamily real estate is a business letter that will let the seller know that you're interested in purchasing their property. This is a non-binding agreement that will outline the terms and conditions of the purchase. The letter of intent is the first thing that you and the seller will agree to. The information that you'll find on this letter of intent is the purchase price, the amount of the earnest money that you're placing in the escrow, the total amount of the down payment that will be made, and also the amount of the first position mortgage. Make sure that you proofread the letter to ensure that it's correct before sending it to the seller, because this is the information that will be copied over to the PSA. Now, the PSA is the purchase and sale agreement. We'll go over that in just a moment. Next, we have the earnest money deposit. Earnest money deposit is the deposit that a buyer would make to the seller to indicate that they want to move forward with the purchase. This deposit could be anywhere from 1 to 3% or a fixed amount of the sale price. A broker will manage the escrow account until the deal gets closed and then give the money to the seller. If there's any problem with the property appraisal, financing, or inspection contingencies, the contract can become voidable and the buyer can receive their earnest money deposit back. However, this is done before the contingency date specified on the purchase and sales agreement, or that money will become non-refundable. The earnest money acts as an incentive for the seller in case the buyer cancels on the deal at the last minute, they get to keep it. It also gives the buyer enough time to arrange funds and perform their due diligence on the property. Due diligence is the process of examining everything about the property in order to minimize your risk in the investment. When you're performing due diligence, you want to review the various sources of income of the property, the expenses for the property, and any vendor contracts that the property has in force. A few items that you'll need in order to perform your due diligence is the T12, the rent roll. You'll need to find out what the expenses are for the property, and you'll need all that information to figure out the NOI. I know right now, you may have a bunch of questions just running through your head, what's a T12 or a rent roll and an NOI? Well, these are some additional investing terms that we went over on our previous meetings. As you're looking into financials of the property, you'll also want to check if it's receiving the market rent for the area. Cedric, what should they know about this?
All right. We're going to talk about loss to lease. It is the difference of 100% market rents and also what you're actually paying for the subject apartment. So let's say that you are renting and the property manager says, look, here's the apartment, it's $750 monthly. Well, Cedric came by to apply for the apartment and I was the most qualified person that they could find, the most qualified person that has come through just yet. But I tell them, I can only pay $700. Well, they wanted $750. I can only pay $700. So there is $50 loss to lease. The market rents $750. I can pay this. So that is a loss. This is where this gets a little interesting. As William stated about the rent roll, there's the gross potential rent. And in this example, that is your 100% market rent. That would be the $750. The gross scheduled rent is going to be what I actually paid. Okay? You subtract your gross potential rent from your gross schedule. There you have it. Take, for instance, let's say you have a 50-unit apartment building. And let's suppose that everybody in that apartment building is paying $700. That's $50 per unit per month. So that's 50 times 50 is $2,500 a month that you are losing as the owner. Now let's multiply that by 12. That's $30,000. Well, I know you may say, well, it's only $30,000, but it's $30,000 that you're losing, not the $30,000 you're putting in your back pocket. So now this is where this really, where the rubber meets the road. $30,000 times a 6 cap, a capitalization. We went over that last month. And as William said, you'll be able to find it on our YouTube channel. But just for conversational purposes, it's a profitability metric to determine the return on investment of a property. You're going to divide that $30,000 by 6%. That's $500,000 of value that you lost. That means that your property is $500,000 less if you were to take it to market and try to sell it. There's a term, you won't hear it tonight, but it's called managing the manager. That's where you, the owner, teach your property manager how to manage your property. Okay? So now with that, we go into income. Income refers to all sources of income. That is rent, it's pet fees, it's laundry, it's RUBS, and other income items. RUBS are ratio utility billback system or billing system. You don't really see that in single family. You see it more in multifamily apartments. The thing with that is there's a big ticket item that most of us owners have to pay, and that's water and sewer. In majority of the cases, it is on us. So what the RUBS system does, it allows us to bill back the residents of our apartment building. It runs about 85%, which you cannot make a profit. Here's the one thing that you have to understand. You cannot make a profit. You can bill back the residents 85% because these RUBS are part of the water sewer are becoming part of your expenses. So again, you cannot make a profit. Expenses refers to operational funds of the building. That can be payroll, that can be general and administrative, that can be repairs and maintenance, insurance, taxes, utilities, as I mentioned, management, and contract services. The thing with expenses, you want to make sure that you keep a cap on those because that's the difference between you winning and losing in an apartment investing. There's one particular piece of expense. It's not an expense item. It's a big ticket item, and it's capital expenditures. Okay. Operating reserves, they're also known as CapEx. Those are big ticket repair items. Going to be your roofs. It's going to be your pavement. It's going to be boilers, chillers. And these are items that you're going to repair probably once as you own the building. Now, if you decide to hold it long term, then of course you may have to do that more than one time. And with that, there's another thing called replacement reserves. The replacement reserves are monthly set aside dollars for repairs. For instance, toilets, your sinks, you have to set this money aside. And depending on how you're trained, it's going to be anywhere between $200 to $350 per month that you have to set aside for each unit, just in case you have to go in and repair some of those particular items. And again, normally you're going to have that in a bank account that you should actually own. It'll be your bank account, but you must allow your property manager to be able to go in and deposit. You should always make that, let me make that clear, that your property manager should only be able to deposit in that bank account. Now, when you have these repairs, you write a check, you take care of it. There's some other assessments that goes along with these properties. William, can you tell us about some?
Yes, one of the assessments that you'll definitely want to look out for is your Phase 1 environmental site inspection. The Phase 1 environmental site inspection is an investigation into the property and of its current and historical use. The process views and investigates the property to discover how it was used in order to determine if there was a potential hazardous condition that might be present on the property. This is a very important assessment to get on the property before purchasing it. This almost reminds me of the old game, hot potato. On the hot potato, the person that gets caught with the ball, that's the person that gets burnt. Same thing with the environmental site assessment. This can happen when you purchase that property, because if there's a hazardous issues that's contaminating the environment, the government's really going to step in, and they're going to step in hard. In 1980, Congress ended up passing a Comprehensive Environmental Response Compensation and Liability Act. That's a mouthful. It's called CERCLA. It's also known as Superfund. The Superfund authorizes the EPA to respond directly to any release or any threatened release of hazardous substances that can contaminate the environment. They could also seek reimbursement of the cleanup expenses from potential responsible parties. The party responsible for the contamination must pay for the cleanup work performed at the Superfund site, and this could extend to those that currently own and operate the site, even if they didn't personally cause that contamination. That's where you get burned, because you could be left paying tens of thousands of dollars to clean up a mess that you didn't personally cause. Make sure that you get a Phase 1 ESA. All right, the next slide that we're going to discuss is the purchase and sale agreement. The purchase and sale agreement is a legal document that contains terms and conditions to transfer ownership of the property. In it, you'll find the names, addresses, and the parties involved. The address of the property, just because you saw an item during your walkthrough, it doesn't mean that it's going to be part of that sale. You want to check to ensure that the legal description of the property and any additional conditions are correct, such as inspection periods or a subject clause. A subject clause is placed inside of a contract in order to allow time for a buyer to perform due diligence on the property. Each of the subject clauses that are part of the purchase and sale agreement will need to be removed in order for the purchase to proceed to closing. For instance, the purchase of a property will be subject to a title search, because you have to make sure that the person or entity that you're purchasing the property from is the true owner of the property. It will be subject to financing and subject to inspection. You'll need to go through the property, through each and every unit, to see what condition it's in, so you can prepare your budget to reposition the building to achieve market rents. After the subject clauses are added and the purchase and sale agreement has been completed, if there's any changes that need to be made to the document, it can be done using an amendment, meaning to take something out, or you can use an addendum to add something in. Addendums are additional terms and conditions that are agreed by all parties involved in a transaction. Once it's put in writing, it is added to the existing contract. With an addendum, you can add the additional terms or items to be transferred with the purchase of the property. For instance, let's just say that you purchase a 100-unit property and it has a maintenance shop with tools and supplies that will cost a lot to replace, or let's say a lawnmower that's being used for the landscaping. You'll want to be able to negotiate those terms into the purchase price and have them written up in an addendum to be attached to the purchase and sale contract. You can purchase multifamily properties in a few different ways. Cedric, what's one of the ways that you secure properties?
Well, one of the ways that I secure my properties are through syndications. There are two ways that you can take down a property, and that's the terminology that is used to purchase a multifamily apartment. There's the joint venture and there's the syndication. So a syndication in multifamily is basically the pooling of funds. You're going out to your investors and you're getting funds to be able to take down this particular property. Now, I'm going to talk a little bit more about syndication here in a minute, because there's a couple of other terms that go along with syndication that you need to know. 506B and 506C. With 506Bs, syndications are neither allowed to perform general solicitations nor advertising. This is governed by the Securities and Exchange Commission. And we all know you don't want to run afoul of the SEC. With the 506B, as it says on your screen, you can have no more than 35 non-accredited investors. Your 506C, this is a great one. This is a great way to do your syndications, because with the 506C, you're allowed to openly solicit. I could go on Facebook, I can go on Instagram, I could go on LinkedIn, I could even go on TikTok. If people would listen to me, they'd probably think I was crazy, but that's neither here nor there. And you can put a billboard up on side of 76. You can openly solicit, but here's the kicker for this one. All of your investors must be accredited investors. So Cedric, what are accredited investors? I'm glad you asked that question. The SEC defines accredited investors are either individual people with gross income exceeding $200,000 in each of the 2 recent years, or jointly income with a spouse or partner exceeding $300,000 for those years, with expectations of the same income level over the next year. Your 506B, you can now utilize that to do your syndication. So just remember, you cannot have no more than 35. But the thing here is you can have as many accredited investors as you want. 506C, there's no cap to it. There's no cap to how many people can be in your particular syndication. However, you must be able to prove that they're accredited. That's the one thing that's very important. And there are documentation that they must send in, and there are actually firms out there who will grab that information and they will verify. They will verify and must verify that they are accredited investors. Now, with joint ventures are primarily governed by contract law. Again, it's still governed by the SEC. It involves a few business partners. So for this example, I'm going to say Cedric, William, Nautica, and Ride It Out. We're all going to buy this apartment building together. We must all be active. We must be all actively involved in the day-to-day management of this property. Not only do we all come in and put whatever amounts of money to take that building down, we have to be actively involved, because if one of us or many of us are not actively involved, you're running afoul of the SEC, and that could put you in some hot water, because basically at that point, you really did a syndication. There's another part of syndication that I want to explain a little bit more about, and that is members' equity. Members' equity is basically limited partners. So remember when I was talking about syndications and we go out to our investors, we consider them our limited partners. Here's the thing. the amount of equity that they hold in these deals are anywhere between 50% and 80% of the deal. You get that? 50 to 80% of the deal. So they're majority owners of this particular property. But here's the thing, they're all passive investors. The actual active members are general partners. That is us. We're going to go out, buy this building. We're going to take it down. We're going out. We're going to source the deal. We're going to do the due diligence. We're going to go and find the money. After it closes, we're going to manage that property. That being said, the equity positions there ranges anywhere between 20% and 50%. Typically, with the manager's equity, I've seen it range anywhere between 20% and 30%. I haven't seen anything yet that's 50%. However, there are times when you may see that. Again, with the members' equity, I've normally seen it in anywhere between 70% and 80% equity. William will now discuss different returns that we will provide to our investors.
One way of calculating what your returns will be is the average annual return. The average annual return is the amount of money earned by the investment over a period of time. And then you divide that by the amount of time that you held the investment to find out what you made each year for keeping that investment inside your portfolio. The average annual return is the average amount of cash flow generated over the life of the investment. So let's just say that you purchased a multifamily property, and in year one, your income was $50,000. In year two, it was $100,000. In year three, you made $150,000. Now, the average for that 3-year time period is $100,000. But that average doesn't tell you exactly how you performed in year one or how you did in year three. So when you want to know the specifics, what you want to go to is internal rate of return. The internal rate of return is a measurement that will give you specifically what you made from your investment. But it's much more accurate way in order to compare it from one asset to another. The internal rate of return includes cash flow from operations, cash flow from other revenue sources like a laundromat on the premises or parking fees. It will also factor in the cash flow from the sale of the property. Your investors will want to know exactly how much they're going to receive from their investment. The internal rate of return gives investors the ability to compare various things, specifically if you have uneven cash flows. For example, when you purchase a multifamily property, you have to honor the leases that are in effect until the end of the term. There will also be units that are empty and they have to be made rent ready. As leases expire, you can increase the rent, and you will also lease out the newly rehabbed units at market rate. So over that period of time, your income will dramatically increase. Your income from the investment is going to look a lot different from year 1 to year 5. And you'll want to track those details of the IRR so you can determine what improvements or additional revenue streams work the best so you can duplicate that on the plan for the next investment. Now, the final term that we're going to review tonight is closing costs. Now, there's many fees that's associated with multifamily properties, and every deal is going to be a little different, especially depending on how large of a deal that it is. However, a few things that you'll usually see are origination fees, recording fees, legal fees. You should also be aware that utility companies may ask for a deposit when you have them switch to your LLC. Also, lenders are going to require you to pay for your insurance a year in advance. These two items alone could add thousands of dollars to your closing costs. So you'll want to review everything the day before you get to closing to make sure that the interest rate, the down payment amount, and the loan terms have been recorded correctly. Cedric, is there something else that you would like to add about the upcoming events that we have in store?
Yeah, absolutely. So what we're trying to do here is educate each and every one of you about commercial multifamily. There are team members that you will need in order to make this happen. There's no one man or one woman show when it comes to commercial multifamily, because things get very convoluted. So our plan in the next few months are to introduce you guys to team members needed for your success in commercial multifamily. We plan on bringing in insurance brokers, mortgage brokers, property managers, syndication attorneys, asset managers, IRA custodians, infinite banking representatives, branding specialists, meditation and mindset coaching. Because trust me, that is one thing that you will need in this business is meditation and mindset coaching. Because when it gets tough, as the saying goes, the tough get going. And we would like you to be a success. That's why we're building these building blocks to help you in your investing career. Back to you, Owen.
Thank you very much, Sid. Okay, that brings us to the end of our presentation for tonight. Next month, we will have Donna and Brian Blackburn. The Blackburns have over 1,200 units under management, and they will be here next month to share their knowledge and their journey with you. This information will be valuable in your multifamily investing. Now, I want to applaud you for coming tonight because it shows that you understand that with the right building blocks, you can build the perfect foundation for your apartment investing career.